Well, Nedbank has kicked off the big four banks reporting season with headline earnings per share having more than doubled during its interim period, reflecting a strong financial recovery, albeit off a low base. The lender has resumed dividend payments, declaring a payout of over R4, but has lowered its growth outlook for the economy, given the impact of the third wave, combined with the fallout of the looting unrest which took place last month. Company CEO Mike Brown joins us with greater perspective on the kind of narrative the numbers present on Nedbank's recovery and that of the economy at large. Thanks so much, Mike, for your time this evening. So Nedbank's headline earnings may have jumped 148% to 5.2 billion rand, but it remains 24% below its 2019 level. And I'm going to be having a conversation about emerging markets' ability to bounce back in just a bit. But are you worried? Because it will translate to any sustainability of the bounce back you've seen over this period, right?
Hi, good evening, everybody. I'm certainly not worried. I think what we've seen in the last 18 months or so is just how resilient Nedbank's franchise is, and indeed how resilient the big South African banks are, because we've all put out trading statements. And, you know, what we saw was earnings drop last year by about 55%, and now we're bouncing back. And certainly from our point of view, no, we did not expect to be back to 2019 earnings during the course of this year, or in fact, during the course of next year. We only expect to get back there, you know, maybe on a run rate basis in 2022, but our medium-term targets are to return there in 2023.
Yeah. I asked the question on whether you're worried, Mike, because some commentary that has come through, as the banks presented their trading updates, was the slight disconnect between the bank's core customers and the GDP numbers, with the bank's core customers recovering faster than South Africa's GDP would suggest. So how do you explain that disconnect that's reflected here?
Well, if you look at our forecast for GDP growth this year, it's 4.2%. Mm-hmm. Actually, this year it was around about 5% before we reduced it by 0.4% because of the level 4 lockdowns. We were only expecting level 3, and we reduced it by another 0.4% from the riots and lockdowns. But generally speaking, GDP growth has been better than expected, supported by very strong commodity prices. And if you look at Nedbank's revenue growth, our net interest income was up about 5%. And remember, GDP growth is a real number, not a nominal number. A little bit complicated, so you need to add back inflation to try and balance those. And our non-interest revenue growth, if you look at commission and fees, which is, the more cyclical element, that was also up around about 5%. So not materially different to nominal GDP growth.
Okay, amidst it all, Mike, you've been citing low interest rates and robust retail credit demand. What approval rate are you looking at, given, the applications that have landed on your desk? Because the group's impairment charge has decreased by 57%. And, that no easy feat in the current climate, nevertheless, I'm sure.
Yeah, our credit teams and our collection teams and everybody, I think, have done an absolutely amazing job. But if you think about, we don't publish approval rates by product category. We actually give people a graph. And you can see what we've actually done is reduced our approval rates in these more uncertain times. But because of our much better straight-through digital processes, what's called not take-up rates. So once we've approved a loan, sometimes, people go to other institutions. They've gone to a number of banks to try out to see if they can get a loan. Our not take-up rates have reduced significantly. That means that we can continue to grow our loan books whilst at the same time improving credit quality through reduced approval rates.
Yeah. How much of a contrast between what you're seeing in the retail market and those consumers that you're catering to, Mike, and then your corporate activity?
There's quite a contrast. And if I just start with loan growth, and then I'll talk about bad debts. From a loan growth point of view, what we saw last year in the second quarter was very strong corporate loan growth in the COVID environment, big drawdowns from most of our corporate clients. But since then, we've seen very strong repayments, and in particular from the commodity sector. So our overall corporate loan books are shrinking, while our retail loan books are growing at around about 5 or 6%. On the corporate and retail side, bad debts do look to have peaked, or in the corporate world, there are still challenges in sectors like aviation, tourism, and entertainment that are still impacted by the lockdowns.
Yeah. Mike, when it comes to transactional activity, that's increased, albeit off a low base. So what's it revealing about, the green shoots in the economy and where things are starting to pick up more so?
Yeah, so certainly there were a number of green shoots in the first quarter, and that did emerge in transactional activity levels now being higher than 2019 levels, which I guess is the real base now, given that 2020 was such a difficult year for everybody. I think the concern is more further out, where, after the bounce back in GDP this year of, let's say, 4 to 5%, our longer term GDP forecasts still remain bound in the sort of 1 to 2% range. Hence the rhetoric that you hear from me every time around accelerated structural reform, policy certainty, and now more importantly than ever, assurances around law and order and the safety of citizens and their assets.
Yeah. So when it comes to the question that's being asked, broadly speaking, Mike, whether banks could grow their top line revenues as well as control their costs to ensure growth in pre-provision operating profits, you're confident that you can, and on a sustainable basis from here on out?
Absolutely. I mean, if you just look at these numbers, unfortunately, we had something called fair value adjustments, which you can actually ignore because they go to zero over time, and they're not really our underlying operations. But if you look at our pre-provisioning operating profit, excluding fair value adjustments, that was up 11%. And our cost to income ratio, excluding those fair value adjustments, actually improved period on period. So that's a real reflection of the underlying business as opposed to accounting nuances.
Let's leave it there. Mike, thanks so much for having joined us on the line this evening. That, of course, Nedbank CEO Mike Brown.